A splendid evening it is to you viewers. Welcome to Equity News on Equity Access, your aerial perspective of stock market developments and of developments in the Zimbabwean economy. Thank you for joining us as we broadcast live from our Hampton studios in Harare. I'm Ibn Mabunda. Let's get on to business. Our news tonight, the Zimbabwe Agricultural Society in conjunction with the African Economic Development Strategies, the AEDS, alongside Financial Gazette held the inaugural Zimbabwe Agricultural Sector Survey in the capital this morning. The event was attended by industry as well as leaders from the government. Dr. Gift Mugano, the Executive Director of the African Economic Development Strategies, presented the findings of the survey. The survey looked at various aspects of the agricultural sector, including mechanization, contract farming, government intervention, crop yields, as well as national output. Dr. Mugano called for improved agricultural practices in light of climatic changes so as to achieve food security in the nation. Let's just have a quick look at the stats so that we get an appreciation of what the presentation was all about. Now, this is a juxtapositioning of the Zimbabwean maize ton per hectare vis-a-vis how other countries in the region are actually faring, and of course that would be wheat. Just a quick look there would reveal that Zimbabweans, in terms of their maize production, they produce 0.64 tons per hectare. Kenya 166, Malawi 167, South Africa 5.3. Then moving on to wheat, there is a similar story. Well, of course, here Zimbabwe is at about 2.2, while Zambia is 7.2 tons per hectare, Malawi 1.3 tons per hectare. Moving on to other grains, you'd find also that you'd also find that there is a differing performance with regards to apples there. Zimbabwe 9 tons per hectare, Kenya 9.8, South Africa 37.8. Well, the same story continues in soybeans, where we have Malawi 0.87, Kenya 1.4, Zambia 1.9, South Africa 1.9. And of course, the story there being Zimbabwe is performing below the regional averages. And so, according to the presentation that he called upon other strategies to be implemented, including mechanization, contract farming, as well as increased participation from the private sector. Dr. Mugano called for the liberalization of the agricultural sector, as well as the introduction of a commodities exchange to allow market forces determine the efficient allocation of products, as is the case in other countries. Our equity access team was on the ground. Let's have a look.
One of the key elements which must be taken seriously by the government is to liberalize the agricultural sector. What we've seen in Zimbabwe is a case study. The AGRIC sector needs to be liberalized to allow players to come in and support the production of the crops, livestock, particularly the crops, the grains, on a demand and supply approach. We feel that as enunciated in the Transitional Stabilization Program, government must expedite the operationalization of the commodity exchange. A commodity exchange is a market for the grains, just like the stock market for capital markets. If you want to look at it from the tobacco side, you are seeing a marketplace where there's an auction trading of a commodity. And this is going to help in the unlocking of funding to the agricultural sector through warehousing system. And we noted when we were looking at our case studies that in Ethiopia, for example, they have a commodity exchange. And this commodity exchange is integrated with ICT systems that a farmer can receive a message on the phone on the demands, what is happening, what are the crops which are on trend. And they are attracting even investors as far as Europe who are placing orders in advance. We need this crop this time. And the commodity exchange platform is sending this information to farmers. Next 3 months, this crop is in demand. So lack of information has been one of the factors which we observed in Zimbabwe. And the commodity exchange can play a critical role to provide that information. And right now, the Ethiopian commodity exchange is capitalized to the tune of 1.5 billion.
Fantastic. Honourable Minister, to talk about the recommendations that were given during the course of the presentation here, that perhaps it's time that Zimbabwe gets to liberalize. But of course, in your response, you did allude to the fact that perhaps Zimbabwe might not be ready for that yet. In terms of maturity that you did actually mention, when do you think that Zimbabwe would be ready to get into a liberalization of the agricultural sector?
As soon as we are self-sufficient, we'll be ready. Because that is the critical component of being able to liberalize. If we're not self-sufficient, we don't grow enough maize, enough soya, enough wheat, and we still remain importers. As long as we're net importers, but as I'm on my side, I don't believe that we will surpass it.
Fantastic. Honourable Minister, to talk about the recommendations that were given during the course of the presentation here, that perhaps it's time that Zimbabwe gets to liberalize. But of course, in your response, you did allude to the fact that perhaps Zimbabwe might not be ready for that yet. In terms of maturity that you did actually mention, when do you think that Zimbabwe would be ready to get into a liberalization of the agricultural sector?
As soon as we are self-sufficient, we'll be ready. Because that is the critical component of being able to liberalize. If we're not self-sufficient, we don't grow enough maize, enough soya, enough wheat, and we still remain importers. As long as we're net importers, but as I'm on my side, I don't believe that we will surpass 2 years without being self-sufficient. I really believe the role that we're playing as ministry, as the president, the role the president is playing, the role that our government is playing, is really on track to lifting up the livelihoods of our people and really changing the economy. So I don't foresee more than 2 years, and what I know is that it's not government. Government is not designed to be involved in these kinds of things. Government is there for a specific role, and the private sector should be there for their role. And so when we liberalize, that means we're empowering the private sector to determine and dictate prices on a supply and demand purposes, or should we say market forces. And that can only happen when we are growing enough, and that's why I said yes.
Now, also along with that is the 38.5% subsidy.
38.8, yes.
How is government funding that particular subsidy?
Well, what we want to do is we want production, we want farm business to be a business. So we are trying to assist the farmer, to cushion the farmer a little bit. In the same time, also trying to help the miller, because the miller will come to us and complain that no, the price is too high, it'll skyrocket food produce. So we've said as a government that there are better benefits downstream by subsidizing at that level than it is for allowing market forces to take over at this stage. With prices will shoot, like I said, it goes back to the deficit, supply and demand. When you're in the private sector and there's a shortage, so you take advantage of that. So we are saying the 38.8%, it's not a loss to government. What it is it's an incentive to our farmers to keep producing more and more and more. Because where we want to get to, we want to stop importing. We don't need to import food. We need to be producing enough food for our country and exporting a finished product. We need to be producing enough wheat and exporting flour. We need to be producing enough soybeans and exporting oil. That's where we should be. We should be exporting this. Okay. We shouldn't be exporting maize. Framework. And what it is, basically, it's a consultative process that we're doing. We're going province by province, talking to people and saying, what do you want the new land policy to say? Do you want us to look at the youth? Do you want us to look at Mazimai? Do you want us to look at merit? And we know the answers to some of the questions, but it's so important to make it a gender-sensitive, all-inclusive process. Like you, as normal citizens, have your word. As youth, you're a youth, I'm a youth. We should have our voice. We should.
Sincere apologies for that bad transmission there. That, of course, was a close-up with the Deputy Minister of Agriculture, who's Honorable Harito Tos, on the developments of the agricultural sector. Moving on, the President of the Confederation of Zimbabwean Retailers, Mr. Denford Mutashu, has called upon the Reserve Bank of Zimbabwe to reduce monetary supply so as to tame inflation, which as of the month of March was stated to have been 66.8%, up from 59% recorded during the month of February. He also said Zimbabwe is still on course to achieve economic growth despite IMF having projected a 5.2% decline in terms of our GDP. We caught up with them earlier. Let's have a look. Inflation. IMF has set an expectation of 40% in terms of headline inflation for the year end. What is your assessment of that particular situation?
I think inflation largely is a phenomena that arises, from the money supply growth or otherwise in the economy. We should be able to close the tap on money supply. I'm not too sure if we really are going to be able to do that in light of the treasury bills that have matured, and I know certainly the government has been negotiating for a rollover, but we probably may have continued to create more money in the economy unnecessarily, because the moment that we're going to continue to create money, it will certainly push inflation on the north side, because so far we are talking of an inflationary figure of more than 60% currently year on year. I don't think that is something that is ideal, and what we also need is to improve accountability, to improve our consummation, because we have got a growing informal trade, and yes, the IMF has come up with their predictions, but we have been here in the country. We are looking at the pointers. We are looking at, especially capacity utilization. We believe that generally it is certainly going to go up, owing to the demand that is there. The constrained demand right now, owing to the decline in real disposable incomes, we believe it's short term. But obviously it will certainly improve as more and more manufacturers come into the economy. They will also ensure that prices will go down, and the majority of Zimbabweans will be able to access affordable goods and services.
In other news, Cassava's EcoCash raises its transaction fees by close to 30%. EcoCash is Zimbabwe's largest mobile money platform with a subscriber base of 8.1 million people across the country, enjoying a market share of about 95%. The raise is in response to inflationary pressures playing out in the economy, as well as instability across the economy. We can expect these changes to be across the board, and of course Telecash and One Money are also expected to follow suit. Meanwhile, First Mutual Properties, a subsidiary of First Mutual Holdings, held an analyst briefing in the capital yesterday with a strong performance being reported. Revenue scaled 9% to $8.1 million, driven by increased occupancy from 70% to 75% across the board, while CBD retailing assets remain subdued. Maintenance costs increasing 71%, profit after tax scaling to 140% to reach $4.1 million, owing to improved operational efficiencies. Let's just get into the stats so that you get an appreciation of where the group is coming from and how the firm has actually performed over the period in question. FMP is seeking to expand into tourism as well as student accommodation. Well, as I said, let's get into. They recorded revenue of $6.4 million, 2015 revenue of 6.3. This seems to full year 2015 they recorded a net loss position of $6.3 million. 2016 again 6.2, while there is a profit after tax of $1.1 million. 2017 there is a growth in terms of profit after tax to $1.7 million, and then for 2018 we've got to see the revenue scaling to $4.1 million. Well, I had a close up with the managing director, Mr. Chris Manyoa. Let's have a look. Since the introduction of the interbank market system, how much foreign currency have you been able to access, and has that been enough to remain operable?
We were not, in most cases, when we were doing our projects, realizing that it is very difficult to be going into a queue for Forex. We identified suppliers who could actually invoice us in RTGS, and that is how we are operating.
To talk about your finance costs, a significant reduction in terms of the finance costs from about 160,000, now it's about 52,000. How do you intend to leverage on such an advantage going forward?
Well, basically what we are saying is that once your finance costs are going down, you are now therefore saying with your debt position, you are getting less and less debt. Your gearing is actually going down. And the ideal position for any property company which is looking at expanding is to ensure that you go out, try to borrow as much as you can within your capability, that which you can repay, and then use it for expansion and also for acquisition purposes.
Fantastic. Now, going forward, two key things: the R&D office park. You did, of course, allude to the fact that 30 to 40% of that particular cost would go toward imports. What is the strategy of the group with regards to the office park?
Most of it is what we even indicated, that out of our revenue, 16% of our revenue is already coming through in the form of foreign currency. That already have got a starting point. Then number two, if you look at potential for capital recycling, you actually say, if I were to make a decision to sell a building today, it is only reasonable for me to sell in the currency which will enable me to be able to build another asset.
And lastly, you mentioned leisure properties as well as student accommodation. Would you want to shed more light? And you also did mention Victoria Falls. What are the prospects with regards to Vic Falls? We've seen a lot of players coming into the picture. Construction of new hotels is actually in progress there. Which niche do you intend to actually cater for with particular focus to Victoria Falls?
When we mentioned leisure assets and also accommodation, we are saying that is the direction of focus, things that we're actually looking at. And we'll pick and choose. Whenever we identify an opportunity, it's not like we go in blind. We'll actually do an assessment and then make a decision of investing. A decision has already been made on Arundel Office Park. That is actually a go. On the others, we are still scouting and we'll assess each investment opportunity and make a decision.
Well, that sums up our news. Up next is news review. Please stay tuned. News review. News review. I'm going to work on those things. Anunzan. Sandra, over the weekend, practice watch shows for intros, breaks, and exits. Right, and work out how you're going to do it. Is that okay? So watch a talk show, intro, break, come back from the break, exit.
It's right. It's okay. Can I go to analyst?
Tutangane kupi. All right. Don't worry.
It's all right. Don't worry.
Aiwa, nsitomboda kutaura nezvake. Tutongoti
Totaura nezvake.
Agricultural Society. Tutaura nezvake.
Okay.
Amen.
And I. Okay. 5, 4, 3, 2, 1.
Welcome to News Review. With me now is investment analyst Tinashe Kaduo. Tinashe, good evening and welcome to the show.
Good evening, Eben. How are you doing?
Can't want to complain. Should only get better yourself.
I'm very well.
Fantastic. Let's cut to the chase. The Zimbabwe Agricultural Society today, of course, holding that inaugural agricultural sector survey, which of course highlights key things, key issues to do with the agricultural sector. But what was of note to me, Tinashe, was the fact that during the presentation, Dr. Gift Mogano did allude to the fact that there is need for Zimbabwe to look at how to improve its methods of agriculture so as to cushion itself against climatic changes, which he said have a negative effect or bearing in terms of Zimbabwe's agricultural performance. What is your assessment with regards to what has been done on the ground and perhaps what we could look forward to in the future? Of course, before we get into the stats.
Thank you, Eben. This is actually a very good development in the agriculture sector to have, the first survey which is actually conducted by private players independent from the government. So, agriculture, there is no doubt that agriculture is the cornerstone of this economy, and over the past years we didn't have an index that actually measured the performance of agriculture sector. So with this first agriculture survey, they are actually working on towards having an agriculture productivity index which will measure the performance of the sector, whether we are going up or down. So this is actually a very good initiative by the Zimbabwe Agriculture Society and by the Financial Gazette, and I actually say kudos to them for that initiative.
Fantastic. Now let's get into the stats. Well, in some one or two things said in the presentation that perhaps we would need to actually look at or inspect critically to get an appreciation of how it is that we actually in this particular setup, and how perhaps we could bring an improvement to our economic situation. Issue there being the hectarage as well as the tonnage per hectare that we actually produce. Let's have a look at soybeans, where Zimbabwe is sailing at 1.3 tons per hectare against what other countries in the region actually producing. Malawi, of course, is below what we are performing. Kenya is way better. Zambia, our neighbor to the north, is performing 1.9. South Africa 1.9 again. Then you have a look at apples. There you have Kenya 9.8, South Africa 37.8, Zimbabwe just at 9 tons per hectare. But perhaps would you want to shed more light in terms of our performance in terms of the agricultural sector, and how perhaps we could actually improve our tonnage in that particular sector?
Maybe for the benefit of our viewers, maybe to give them a bit of background, agriculture actually is a very important sector of the economy, which actually contributes about 23% of formal employment. There are also around 70% of rural families that directly benefit from agriculture. So if you look, there are around 1 million communal farmers who actually feed from the agriculture sector. So it's actually a very key economic driver, and the issues to do with the productivity. It actually stems back from the land reform program, where we reallocated land to communal farmers from the former commercial farmers. So from the land reform program, we actually lost in terms of knowledge and expertise from those commercial farmers. The structure that we had before the land reform was, there was once that huge commercial farmer who will be the epicenter of other communal farmers. So the communal farmers were actually benefiting from the commercial farmer in terms of the extension services and also knowledge from that farmer. So with the land reform, we actually lost that knowledge chain, or we lost that ecosystem which was actually destroyed. So that's why you see our productivity across all crops and even in livestock, they are actually poor when compared to regional averages. If you look at apples, which is an indication of our horticulture, our major competitors are South Africa and Kenya. We are producing 9 tons per hectare when compared to South Africa is doing 37.8 tons per hectare. There's actually a lost opportunity there. Traditionally, our Mazoet citrus and the farms in Beitbridge, they used to produce more than 15 tons per hectare before land reform. So we are seeing those farms, maybe much of it laying idle or being used for other uses other than horticulture. And also, if you look to issues to do with your soybean, there is lack of developmental or knowledge, which is actually maybe to do with your government policies. So at the developmental stage, government plays a critical role in terms of educating the farmers on best practices to undertake that production. Then if you also look at other crops such as maize and other grains as well, we have seen most of farmers who undertake that crop production relying much on rain-fed production, and most of them, they are also still using your traditional methods of production. They are not mechanized. That is actually the major setback in terms of productivity level. Our competitors in the region, the likes of Zambia and South Africa, they have been investing much in terms of mechanization and also in terms of extension services. In terms of extension services as well, the donor community, especially in Zambia, has also been carrying out a critical role in terms of supporting the communal farmers as well. So I really believe that with re-engagement with the international community and also investing much in agriculture value chains and in mechanization, as well as doing some studies in those countries that have been successful in terms of being productive in your agriculture, we can pick the likes of Israel. That will actually help us in terms of increasing our tonnage per hectare.
Well, let's talk about a significant statement that was issued, of course, following the report, which Dr. Mnganu says maybe it's time for Zimbabwe to actually liberalize and allow market forces determine the allocation of resources and products in that particular sector. That's on the one hand. On the other hand, in my close-up with the Deputy Minister, Mr. Harito Tos, he said perhaps it would be premature for Zimbabwe to engage in such a move as that could perhaps drive a certain percentage of our population into hunger. What is your assessment of that?
Markets are actually good for having a proper general price indication. But if you look at our productivity levels, they are very low. So if you liberalize the market, you might see most farmers actually moving away from your grains, which actually attract lower prices, maybe going to more or those your cash crops, the likes of tobacco and soybeans. So this is actually to say let us liberalize the market of grains. I think I would support the Honorable Deputy Minister. I feel that it's actually premature to liberalize the market now. Our farmers, they still need that support, they still need that subsidies, and they still need that accommodative price for them to be motivated to still undertake those grains production. So to really liberalize the markets currently is actually premature.
Okay, but on the other hand, I would also want to shed more light in terms of how South Africa runs such kind of a system. You also have Rwanda on the board. You also have Ethiopia. Now, in Ethiopia, this is where it's actually interesting. Before you come in, hold on a second. In Ethiopia, this is where it's actually interesting, where they actually put in $1.5 billion just to allow that system to facilitate the allocation of resources in that particular regard. So I think as and when Zimbabwe is ready, and I do hope that is actually sooner, we should look at how it is that we can capitalize that particular initiative, as well as how it is that we can see to that it runs efficiently and allow the allocation of resources in that regard. You had a point to raise.
I wanted to say, if you look at the markets that you have given as an example, the likes of South Africa, the likes of Ethiopia, the likes of Kenya, those are much more developed markets which had invested a lot in terms of capacitating their farmers, especially in the technical aspect and also mechanization. In Zimbabwe, we are still lagging behind. After that land reform, after you take a certain initiative, there is a learning curve in the process. We have seen some of the farmers that have been relocated to certain farms. They have been experimenting in terms of certain crops production, and I believe they are still in their learning curve, part of production. So this is where the government should come in terms of policy to facilitate the learning of those farmers, offering extension services. That's where agritechs should be capacitated and have extension officers dotted around all the key areas, especially those areas that produce your grains.
Okay, now very quickly, President of the Confederation of Zimbabwean Industries calling for the Reserve Bank to actually cut down on money supply so as to tame inflation, which seems to be spiraling out of control. What is your assessment of that?
Inflation in Zimbabwe is two-sided. The first side is, those high expectations. Expectations are high that, inflation will remain elevated. This is actually emanating from loss of confidence, which is actually a result of, your policy implementation or a policy announcement by the authorities. The other side is your supply side, where your austerity measures, yes, they are hitting demand, but it seems that the supply side is shrinking faster than the shrinking demand. So to say the central bank has to reduce money supply, that's actually a noble initiative, but the implementation aspect is actually something that we need to really investigate. Maybe one way the central bank might do is maybe to issue long-dated paper, maybe to mop up the excess liquidity such that money supply will be reduced in the economy. But the other side, if you look at the growth numbers of the IMF is anticipating a negative growth of 5% of GDP. It technically means that we are in a recession. So if you are in a recession and you reduce your money supply, your growth will be further ahead. So we are actually in a quagmire where, in terms of policy direction, it's really difficult to say what should we prioritize first. So if we really want to tame inflation, but it might come at a cost of further low growth.
Okay, interesting. Moving on to other stories, ECOCASH tariffs hiked, and these are the big players in the mobile money sector. I mean, they've got 95%, and now that they've actually increased, is that not of an inflationary factor?
They're actually responding, to all these macroeconomic problems that we have been discussing in all our shows. Inflation is rising, and is actually rising at a faster rate, and you have seen the service sector was the only sector that had not responded in terms of rising, the charges and even the interest rates in those sectors that are into lending. So if you look at ECOCASH, they have reviewed their tariffs in line with inflation, and it's a macroeconomic situation that we are in. It's actually a macroeconomic problem, and I believe other players as well in that sector may follow suit. We have seen also even in the banking sector as well, banks are also increasing their charges as well. Standard Chartered, for instance, it increases its business conditions. Then we are also even seeing banks also increasing their lending rates as well. I've seen the likes of Stanbic are trying to negotiate lending rates above the 12% threshold. They're negotiating percentage around 15%. So this is actually a response to the macroeconomic environment that we are operating in.
But look here, Tinashe, we have a situation where inflation is already spiraling out of control, and then now with the introduction of new charges in terms of transaction fees, that would obviously spell out higher inflation. Then it becomes a cycle, and we continue on that path.
It might not spiral into higher inflation. Maybe a rational individual might reduce transacting over that platforms. Maybe might demand more cash.
We have a cashless society.
If it's available. But we are in a cashless society, so maybe individuals might be forced maybe to move out of these mobile money players, maybe to go into the conventional banking system. Maybe use your cards when ECOCASH charges are high.
Equally, the banks are also increasing their fees. I think last week we talked about Standard Chartered. Then we also did talk about Stanbic also joining that bandwagon.
What we might see playing out is maybe we might see your transaction volumes in terms of these mobile platforms maybe going down, from those billions of transactions that we are witnessing on a yearly basis, maybe to levels lower. But this will actually increase the demand for cash, which will actually motivate the authorities to introduce, the much dreaded local currency.
We're just going to take a break. When we come back, we'll have a look at the performance of First Mutual Properties. Just for clarity, yesterday we reported on First Mutual Holding, which is the group, and today we report on First Mutual Properties. Actually, the setup was that there was an analyst briefing for the First Mutual Properties, then First Mutual Holdings. Please stay tuned. Welcome back, viewers. I'm still with investment analyst Tinashe Kaduo. Well, Tinashe, First Mutual Property is releasing financials day, revenue scaling 9% to 8.1 million. $1 million, driven by increased occupancy from 70% to 75%. How relevant are these figures in telling the story of how the organization has actually performed?
For First Mutual, it's actually a very good performance, and they performed above the odds. If you look at the property market sector for 2018, the real estate was actually a depressed market where you've seen occupancy level, especially in terms of your CBD and your industrial areas, are going down due to economic activity. Real estate is directly correlated to the performance of the economy. So when your economy is not performing well, it means there will be not much economic activity. So you lose, your occupancy, especially in those prime spaces such as your CBD and your industrial space. So what you've seen First Mutual Property doing was to diversify its property market, being more aggressive in terms of residential and the retail space. In residential, demand was actually, spurred by that rapid increase or that rapid deterioration in terms of your exchange rate and this anticipation of your currency, the RTGS dollar, and as well as your currency volatility. So those investors that want to preserve their value, they were actually, hedging or investing into the property market, mostly in your low cost, your residential space. So this is actually the major driver of your First Mutual property revenue, which you have seen your revenue actually is remaining above the 6 million mark. Then we have seen also the PAT rising as well from your 1.1 million in full year 2016 to 1.7 in 2017 to 2.9 million in 2018.
Okay, just to stop in your tracks. According to the report, there are actually plans to actually expand the Mount Pleasant Business Park, and they said they've put together a team of experts to look into how it is that they can get into that expansion, the time frame. How important do you think that development would be to the group?
Most players,
to the unit, sorry.
Most players, especially in this space, they're actually taking a long-term view, looking at the macroeconomic fundamentals. Our long-term view, especially for this economy, looks brighter. So they're actually, preparing for that economic takeoff. So if you look at expanding that commercial park, the Mount Pleasant Business Park, they're actually saying in the long term, economic activity will pick up so that there will be much demand for your office space. So they're actually, trying to penetrate that space and increase.
Very quickly, Tinashe,
in that space as well.
They also spoke of, the chief executive spoke of expanding into leisure, and they're looking at Victoria Falls. They're also looking at getting into accommodation. But let's talk about their interest in getting into Victoria Falls for the purpose of leisure properties. Well, we've seen a lot of players coming into the space. ZPI coming in with Sawanga, with the property in Sawanga. We've also seen Palm Lodge investing $15 million into that. Old Mutual did also indicate that they acquired 9.9 hectares of land in Wange, 6.6 hectares of land in Victoria Falls. I mean, there has been that interesting development, that vibe, that hype around Victoria Falls. What is your assessment? And now that First Mutual Properties want to get into the very same market, what is your assessment of that particular development in that particular place?
If you look even at a policy level, at government level, your Victoria Falls was actually, identified by the government to be part of, a special economic zone. The Mosatunya special economic zone was actually the first pilot says that the government is trying to undertake. They want it to be, your services hub, and your and a tourism hub as well. So you're seeing all these players, trying to have a control or trying to have their presence in that special economic zone. It's actually exciting for First Mutual Properties, and it's actually a good thing that it's not lagging behind of its peers, and it's actually something that will enable it to maintain its growth momentum.
All I realize. Well, thank you, Tinashe, for the insight. Viewers, please stay tuned. Up next is a focus on the markets. Welcome to Markets Daily, and with me is investment analyst Anisu Jumbumo. Anisu, good evening and welcome to the show.
Good evening, Iben. How are you doing today?
Fantastic. Can't won't complain. You don't get better yourself.
I'm alright, thank you.
Fantastic. Let's cut to the chase.
Alright, the markets are on the positive again. Both the industrials and all-share index did notch up 0.25%, being pushed up by top 10 indices, which came up 0.35% to 119.8 points, pretty much consequent to Delta's 1.09% increment there, as well as cassava that only inched up about 0.13%. And then Old Mutual and Padenga also extended their gains, while Citgo and Econet were on the negative today. If we just move on to our to our 5-day trend, we do realize that the all-share index is at 0.37% ahead of its prior week level of 125.82, while the industrials index is 0.44%, and the mining index is now down 3.43% as it stayed stable today. If I just move on quickly to my rises and fallers, we had about 7 winners and 6 laggards. Of the 7, Turner was leading that pack of
Of course, they just posted a positive performance, recovering from a series of losses, and also the fact that they're benefiting from a tax amnesty. I mean, it looks quite positive. So that perhaps that could explain what we are actually seeing reflected there.
I think we can. I wouldn't really pin it down to that. There is still much to see for them, how they're going to perform in this coming financial year. Yes, they may have benefited from a tax amnesty and the like, but then there is still a turbulent economy coming ahead. It may be a difficult time for them again going forward. I mean, construction may be down again, especially considering that we are under threat of a recession in this year, and stagflation seems to be appearing in the economy. So it may be a tough year for them. Their earnings may not go as high as would be expected, but they may ride on the inflation wave that has put most of other counters on the stock exchange ahead of their revenue targets in the prior year because of inflationary pressures that they capitalized on. So the 20% could be a reason of a closed period having ended. We could really never tell how much investor sentiment is towards such a counter right now. But NMB, which is a banking stock, did added about 14.29%, coming up to 24 cents. A lot of banks have been enjoying good increments in their fee and commission income aspects in that regard for their total incomes. They may be one bank that could be enjoying that as well, because they did launch a couple of products in the prior year where they introduced POS machines, which are very much easily accessible and very light for people to carry around. So it could also push up their numbers in terms of their fee and their commission income. Though it is a little bit worrying that most of the incomes for banks is coming in from government bills, which are treasury bills. Yes, they're sovereign treasury bills, but long term, with inflation going up, the return rate may not be very lucrative for them when they then want to have to roll over or just hold on to their assets. Delta at about 1.09%, while Old Mutual did inch up 0.59, as well as Badenga. We've spoken about those. Zimbabwe was on the other end of the yardstick, where 6 laggards away. It was the worst performing counter, letting go of about 20%. Twinning that was Fidelity Life Assurance, that settled at 7.04 cents, while Zimbabwe Holdings Limited gave up about 5.3%, and Econet and OK and Econet in that respective order kept the laggards set for Econet to settle at 107.76 cents. While now for forex market, it is still a race between the interbank and the parallel market. The parallel market seems not to want to be caught up with. A lot of government officials did expect for the interbank rate to converge with the parallel market rate, but then that has not
seems to be very much elusive.
Yes, it's becoming even more feeble now with the interbank rate now trading at about $3.2. We do expect it to keep on weakening. Trade figures did show that we had a stronger position in terms of trade deficit, but then as is pretty much reflectionary of how the economy is performing. Not a lot of foreign currency within the country, depressed demand that is also within that region. So which also spells out the issues that IMF has actually pointed out, that we could be facing a recessionary period because of how we are also heavily dependent on imports. So with imports also coming off, it may not be a reason of government being able to tame that area, but then there hasn't been much demand coming in from a lot of people because of how taxing it has been becoming, and the lack of foreign currency thereof. So with that strong opposition in terms of the trade deficit, it should have spelled out something a little bit different for our interbank rate, but it seems to keep on weakening at the current rate, while the Old Mutual implied rate also did weaken today, coming up to $4.02, while the local counter did add on its local boss.
Well, thank you, Anesu. Thank you, viewers, for watching. Don't forget to like, subscribe, follow us on Twitter, Facebook, and to visit our website www.equityaccess.net. From the team here and I, Donkey, and good evening.